in A and B module, you would have studied about accounting concepts. Okay. In this module, you have to study about the financial management part, I can say, or little bit financial mathematics part also you have to study. Okay. So here mainly you are having theory plus few practical questions you will be getting. Okay. And in this module, you will be having few theory questions as well as practical. So what you have to do, you have to go through the concepts also what I'm giving, and also you have to practice the numerical questions, the practical questions which we are doing in the class. Okay. So if we look the chapters which we have to do here, which we have to go through it here in this module. So basically, you are having introduction of management or introduction of financial management. Sorry, introduction of financial management. You are having. Then you are having time value of money, bond valuation, and then you are having financial management concepts. Okay, like we say, cost of capital, capital structure, leverage, little bit. Okay, and ratio, derivatives, leasing and finance, and forex. So this is how your topic goes. Okay. So same way we are going to divide the topics in different parts, and then we are going to learn. Okay. So first let's understand the basic meaning of financial management. So if we can see, yeah. Okay, so if we just look the basic meaning of financial management, so basically it's the process of planning, organizing, directing, and controlling the financial activities of an enterprise. Okay, so in any enterprise, how we manage our finance. Okay, so beginning, if we see in enterprise or any company or any organization, they need financial resources, right? So how you are acquiring those financial resources? What are the sources are there from which you are acquiring those financial resources, and how you are utilizing those resources. So this is what we are going to do here, that how you are acquiring and how you are utilizing it. Okay. So this is the basic meaning of financial management we are having. Okay. Then if we look for objectives of financial management, so basically if we talk about, so mainly wealth maximization and profit maximization are the main objective of any for any organization, if we talk about. Okay, so when we say wealth maximization, so what we say about wealth. Okay, so when we say somebody is wealthy, in simple term or day-to-day term, so if we say somebody is wealthy, means we say, okay, somebody is having 4 or 5 cars, 2 3 buildings, or good bank balance, right? Then we say somebody is wealthy, right? So similar way here also, if we say and we are planning to maximize the wealth. So here we talk about in terms of financial health. What is the bank share price, or what is the share price? Uh, what wealth they are having, right? So how market value can be increased, or market value uh, increases. Okay, so that is the main purpose of any organization we are having. We try to maximize the wealth, and second is profit maximization. So we try to maximize the profit. So everybody wants to earn more and more profit, right? So they want that more return they should get. So to meet their short-term financial goal, or long-term means we talk about wealth, and short-term means we talk about profit. So these are the two main. If you see other objectives also, it can be maintaining liquidity and solvency. So financial management helps in maintaining liquidity and solvency. Okay. So liquidity means you'll be knowing, or you would have studied in module A and B, right? To meet your short-term obligations. Okay. Like you are keeping some cash, right? What is the reason? To meet some short-term obligations, some suddenly some requirement, some emergency thing has come. So to meet that, you are keeping it, right? Solvency to ensure financial stability, right? So solvency, if suddenly you become broke or you're not having money to pay, right? So some liquid funds you are keeping for it, right? Ensuring efficient utilization of resources. Obviously, you have to see that how well you are utilizing all these resources, right? It's not like that when money is coming, simply you just invest how you like, right? No, you always see that which project, which investment is giving you better return, right? So, efficient budgeting, cash flow, performance monitoring, this is all you do, right? So then if you look the basic functions of financial management, so it talks about uh, three decision areas. Okay. So one is investment decision, financing decision, and dividend decision. So this is what I was talking about, that when you are getting funds, right? So obviously those funds should be utilized. Those funds should be used, right? So the funds will be invested in different projects based on the profitabilities or based on the return what you are getting, right? So various investment decisions we are having, which we are going to study later, like we talk about payback period, we talk about net present value, we talk about IRR, internal rate of return, right? Or average return, or we talk about accounting return, right? So we have different methods to evaluate or to take investment decisions. Okay. Same way we have financing decisions. So here in financing decisions, you have to see that which capital structure you are choosing. One second. Down it is. Okay. So it's very important which capital structure you are choosing under financial decisions. Take for example, when you are using the capital structure, right? So obviously, when you need funds, when you need money, what all option you will be having? Okay, from where you can take the funds? Can you tell? Okay, loan is one option. Any other? So these are reserves and all internal things, right? And obviously, you are in bank, so you will say, okay, bank loan you can take, right? That is also one option. Or you can
IPO, sir.
borrow from your. Yes, tell me. Yeah, IPO is also there. Okay. Okay. So basically, you can borrow funds from public, that I can say, right? Correct. So, or you can collect money, or you can take loan or some money from your friends, relatives. That is all option also you are having. But if you want to take money from your from public, okay. So what all options you are having, right? So what all sources you will be having, right? So normally you would have heard about equity shares, right? You would have heard about debentures. You've heard about this preference shares, debentures, equity shares, right? So this is what we have to look here, that how we are going to raise the fund. So these three options also you are having, or bonds also are there. So these three options you are having if you want to borrow funds from the public, right? So equity shares you can issue, okay, based on your capital valuation. Equity shares, the number of equity shares will be issued, right? And obviously, public will invest in that. Public will buy those equity shares, and you will get the funds. Okay. So when you issue equity shares, what public is going to get, or what investor is going to get in return? So you have to keep in mind, in case of equity shares, it's like the honor, right? It's like you are the part of the enterprise, or you are the owner of the enterprise, right? So you have to keep in mind that when you are investing in equity share, you will be having voting rights. Okay. And you will be getting dividends. So all the shareholders, whether I talk about equity shares or preference shares, so when company makes profit, company gets profit. So then only company will be going to pay the dividend to you. Okay. The shareholders are going to get dividend when company is making profit. Similar way, preference shares we are having. So this is also dividend you are going to get, but only difference is preference shares will not be having voting rights. Preference shareholders will not be having voting rights. Okay, what preference they will get? So if first preference in dividend payment they'll get, and second preference they get at the time of winding up the company if we are closing the company. So we have to give back the money of investors, right? So first preference will be given to the preference shareholders. Okay, that is the benefit you are having. Third thing we say about debenture. So debenture is basically loan only. You can say term loan or debenture. So it's like a promissory note. Okay. So here, if you are investing in debenture, the investor is going to get fixed interest every year without fail. Okay. Whether company makes profit or loss, doesn't matter. In case of equity and preference, you have seen that the dividend will be paid when the company is making profit. But if you are investing in debentures, so it's like a term loan, right? So obviously loan means you pay interest, right? You pay EMI without fail, right? Whether you are earning, you are not earning, doesn't matter. If you have taken loan, you have to pay it. So similar way in debenture, debt or debenture we say. So here also if debenture holders, we have to pay interest every year without fail. If company makes profit loss, doesn't matter. Okay. So these are the sources we are having. Obviously, reserves also somebody has said. So that also can be one source, internal source. And that obviously companies doesn't have to depend on somebody else. So reserves can also or one source of getting funds. Okay. So these are the financing decisions we have to take here that okay, if you have to raise capital, what all options you should choose, whether you should go with equity, whether you should go with debentures, whether you should go with preference shares. So this decisions we are going to take here that what should be my optimal capital structure. So what proportion I should choose. So that also we are going to learn later that okay, on what basis we can decide that which capital structure to choose. Okay. Uh, Third is dividend decisions. So obviously, just now I said that you are going to pay dividend when company is making profit. Okay. Now, suppose I say we have two companies, A and B. Company A is paying dividend of 8%. Just for example, I'm telling. Companies B paying dividend of 2% on profit, what they're generating. So obviously, in which company you will be investing? Can you tell? The company which is paying higher dividend or the company which is paying lower dividend? Okay, right? Obviously, which gives you more income, which increases your income. There, everybody wants to invest, right? So same thing, companies also they do. Uh, if they want to attract the investors, if they want that more investors should come in their company and invest. So what strategy they use it? So they see that okay, let's keep it higher dividend, pay higher dividend, so that more and more investor will come. If company is mature enough, right now they don't need any kind of investment, they have sufficient funds to operate everything, right? So they will see, okay, we should not keep on increasing the dividends. Let's keep it average something or below average, right? So this is what dividend decisions we are talking about. Okay. And also you have to keep in mind that suppose I say total 100% or 100 rupees, suppose I say 100 rupees is profit. So what we call as retained earning reserves, somebody said no. So we have retained earnings. So obviously out of 100 rupees, suppose for example, I say 40 rupees company is keeping with them. So this 40 rupees, what they're keeping with them for their growth, for their expansion, for their expenses, right? So that is only called as retained earning. That can be utilized for any purpose. So that is called as retained earning. So out of 100, this 40 is retained. So remaining 60 only is your dividend or dividend payout ratio, you say. Okay. So sometimes they can also say, like, suppose one is there and they say, okay, uh, or for example, I say, dividend payout ratio is 0.4. Can you tell what will be the retained earning? So if the dividend payout ratio is 0.4, can you tell what will be the retained earning? Like 1 minus 0.4. Means if what you are paying, so retaining is 0.6. So it's like in proportion, right? So always probability will be equal to 1 only. Okay. So like that also a small question sometimes ask, or maybe later we'll see where you can just calculate. So these three types of decisions we take here: investment decision, financing decision, and dividend decisions. Okay. Is it clear? Is it clear?
Yes, sir.
Yes, sir. Yeah, this is just basic. I'll give theory also means to read it. So you can just go through it. If anything is there, you can obviously ask. Okay. Then we have to see role of finance manager in bank. So what role they play? So obviously fund allocating among assets. What are the sources of fund? How we allocate the funds, right? So whether we should put for fixed assets or we should maintain cash balance, right? Liquidity and profitability balance they have to see, right? That how we maintain a risk and return assessment they do. How much risk is there in each project? How we can assess it, right? Compliance with RBI norms and financial regulations. This is the job of financial manager. Strategic financial planning. Okay. So what should be the budget? How forecasting we do? How we can improve it? How we can monitor the performance, right? So these are the basic things we are having in introduction chapter. Okay. So that you can study in detail. Now, what we have to start with here. So, obviously, in your textbook, or if you see Macmillan textbook, directly after this, they would have started ratio analysis. Okay. So, that we are not going to start right now. Okay. What we are going to start right now, as I said, that we'll be studying in different blocks. Like, first, we'll talk about the business mathematics parts, that is financial uh, mathematics also you can say it. So that is like time value of money and bond valuation. So these two things we are going to complete first, which is very important. Okay. So now we are going to talk about time value of money. You are able to see my white screen, what I'm writing. So let's understand first what we call as time value of money. So time value of money is we are trying to find out the money value based on time. Okay, so how the time changes. Obviously, the money value also change, right? Due to inflation, right? So money value is also going to change. So take for example, suppose I say that if 10,000 rupees I am giving you right now, okay, 10,000 rupees I'm giving you right now, or 10,000 rupees I'm giving you next year. Which one you will prefer? So that is one reason, right? That there is no guarantee that next year I'm going to give you the money. Correct? That can be any reason. I don't want to give, or the situation will not be like that, right? Or next year, who knows, money will be there, or company will be there or not, right? So that is one thing is uncertainty. Okay. Second thing, what we have to talk about, suppose this 10,000 rupees you take right now, okay, and you invest somewhere, or you use that money for some kind of investment. So by next year, obviously in 1 year, that amount, maybe it can be uh, 10,040 rupees, 10,400 rupees. It can be anything, right? So obviously the money value will increase by next year if you invest. Okay. So obviously if you take next year, it remain 10,000 rupees only. But if you take right now and you invest somewhere, you put your money somewhere, then it can be somewhere 10,400, 11,000, 12,000, who knows, right? So it's always wise, it's always beneficial to take money right now. This is what we have to understand here in time value of money, that how money value is going to change based on time. Is it clear? The meaning is clear what we are doing? Okay. So here two concepts you'll be having in beginning. One, we talk about future value. So obviously you have seen that uh, we talk about money value in future. Like right now, if you already are in bank, so you know that right now if you invest or if you put any money, after 3 years, after 4 years, after 5 years, with certain interest become how much. Okay. Or also we calculate that, okay, if there is some future requirement, okay, maybe in future you need 5 lakhs rupees, future you need 10 lakhs rupees. So how much to invest right now? Okay, that is what we are talking about, present value. So these two things we are talking about in under time value of money. One is future value and one is present value. Okay. So earlier in your school days or maybe earlier days when you have studied mathematics, okay, or maths. Okay. So earlier you would have known that if we have to calculate simple interest, what is the formula? P into R into T by. And what is the difference between simple interest and compound interest is, in simple interest, the interest will be calculated on principal amount, right?
Yes,
And
sir.
every year the interest remains same, isn't it? Suppose I say 100 rupees, interest is 10%. So it remain 10 rupees every year, right? But in case of compound interest, the principal first year suppose 100 rupees, second year principal plus interest will be your amount, right? So your suppose 10% means next year your principal will be 110 rupees. So your interest will be calculated on 110 rupees, not on 100 rupees. So here it become 11 rupees. Okay. Then again next year principal will become 121 rupees. Okay. So that is the basic difference between simple interest and compound interest. Okay. So now, why I'm telling this? Because earlier you would have studied when we calculate compound interest, so you were having this formula, right? You remember this formula? We are using this, right?
Yes, sir.
So basically, we were calculating amount. So amount can be anything in the future. That can be after 1 day, after 1 month, after 2 months, after 3 months, after 1 year, after 10 years. That can be anything, right? So that only, instead of writing amount is equal to P into 1 plus R by 100 to the power T, instead of writing like that, now amount, what we say, amount we don't say, we say as future value. Okay. We say as future value, and principal I will say as present value. Means anything we invested in the beginning, right? That is your principal amount. In beginning, what you have invested. So now we say, okay, this is your present value. So future value is equal to present value into 1 plus R to the power T. I can say T also, I can say N also. So instead of writing R by 100, we just write R because we convert into decimal itself. Okay. Because nowadays calculators are allowed. Earlier days, if you remember, calculators were not allowed. Most of the things we have to do manually, right? Correct. Rarely somebody uses calculator. So now accordingly, they have modified the formula. So if anywhere you have to calculate future value, your formula is present value into 1 plus R to the power n. Okay. Then few jargons, few terms you can remember in any question. In any question, wherever they say the word or term or jargon like this, find the amount at the end. Hence, okay. So these all words tells about future or present. Okay. So keep in mind in any question where they're talking about find the amount at the end of 5 years, find the amount after 5 years, find the amount hence 5 years, means we are talking about future value. Okay. That you have to keep in mind. Now let's one example. Suppose I say present value is 10,000 or 1,000. Okay. Rate is 10%. Time is 3 years. Find the amount at the end of 3 years, suppose I'm asking. Okay. So we can directly put in the formula. Future value is equal to present value is 1,000.
Plus 1 return.
10% means you can write as 0.1. Okay. And
3 years.
sometimes by mistake 10% either I write 0.01 or somewhere it's written 1% I write as 0.1. So be careful that what correctly you convert into decimal. Okay. So for that you have to be careful. So 10% means I can write as 0.1 and power n means 3 years. So you can solve it. So how much you are getting? You are carrying calculator with you? Okay, if you're not having calculator, you can download from Play Store any Casio calculator or something like that. You can, or Citizen calculator, you can download like this from Play Store. Second. Thousand into 1.331. Correct? So 1,331 you would have got. So at the end of 3 years, it will become 1,331. Okay. Now, this is very simple question, easy question, where you have just got the values. We can do the calculation easily. But sometimes I will say, okay, can you calculate means 1.1 to the power 20 in your calculator. Okay, this is just simple. Maybe 3 times we have to do. So we'd have done 1.1 into 1.1 into 1.1, right? Correct. But somewhere if power is more, like 1.1 to the power 20, 1.1 to the power 30, 1.1 to the power 40. If power is more, how will you do the calculation part? Okay. So I hope you all have this calculator, right? So always when whatever value they are giving, always first you multiply 2 times. Like 1.1 into 1.1 you do and plus is equal to what? Always first multiply 2 times. So how much you are getting?